Hello everyone. In today's video, we're going to go over my $100,000 portfolio that I manage at the age of 21. We're going to go through and do a full breakdown of all my holdings, including my new cryptos I bought and two new companies I started a position in last week, which are Meta and Duolingo. I'm going to go over and discuss my investing thesis for these companies and why I believe they're undervalued and a great buy today. And finally, we get to some news. We have Tesla shareholders approving Elon Musk's $1 trillion pay package. We are going to go over what this means for Tesla, how this pay package is going to work, and my thoughts on Tesla's future. Right after this announcement was made public, he goes on stage to the annual shareholder meeting and starts dancing with robots to celebrate. So we're going to take a look at that as well. Tom Lee went on to CNBC to discuss why he believes the S&P 500 could reach new all-time highs. So we're going to take a look at these interviews and I'm going to give my thoughts and opinions. We start off today by giving a quick portfolio update of how things are performing. So in my tax-free savings, I just have the iShares XEQT ETF. In my first home savings, same thing, just the XEQT ETF. In my non-registered account here, I have Duolingo, Meta, and XEQT, and we'll be covering these two positions later on in the video. And here we have our crypto account. I started my crypto position on October 10th during the big crypto liquidation, and it gave me a chance to buy in a lot cheaper, and I've continued to buy in over the past few weeks as the price has gone down. So these are the main 6 cryptos I'm holding. Bitcoin, Ethereum, and XRP are the 3 main cryptos I'm holding. Those are the 3 that I'm going to keep allocating the most amount of money to consistently. Then we have Cardano, Dogecoin, and Solana. And those 3 are just speculative coins. So I'm just adding a little bit of money over time. I have no plans to sell any of these anytime soon. But I figured it's a good time to start buying into crypto since prices are significantly cheaper and it's a great time to start a position. I had a lot of cash on hand going into October, and I figured it's a good way to utilize the cash. Right now, Bitcoin is at 143,000. The last time it was at this price was around December 10, 2024. So by buying the dip, it allows me to almost essentially go back in time and buy Bitcoin a year ago at this cheaper price, which is a big advantage. If we go over to XRP, we'll see the same thing. Over the past month, it's down 21%. Over the past 3 months, it's down 28%. And I bought quite a large position here of $2,500 Canadian total. My big cash position I had in my portfolio going into the beginning of October, coupled with the fact that crypto had a big liquidation on October 10th, gave me the perfect opportunity to buy in, and I'm glad I did, because I plan on holding this position for a very long time. I have no intent to sell. We move on to our non-registered account here, where we have our 2 new stocks, Duolingo and Meta. We're going to start off with Duolingo. I started buying Duolingo on October 29, 2025, and I've added to the position as it went down over time. The recent sell-off that you see here is due to the earnings call that happened on November 6th, and we're going to go over that. So if we look at Duolingo over here and we go to the price, as you can see, over the past month or over the past week, the stock sold off about 25%, and that's due to the recent earning call that happened November 6th. Now, if we look at the company and how it's doing, we see the revenue here, how it's up 40% over the past year over year. The revenue looks good. You have the subscription revenue going up very, very fast. We have the daily active users going up fast. We have the monthly active users going up. There was a small dip in Q2 of 2025, but it seems to have regained ground and now it's back to new all-time highs. We even go to the paid subscribers. So this is how Duolingo makes majority of its money, through paid subscribers, and we have all-time highs at 11.5 million. Originally, Duolingo was in the negatives, and now they're net income positive. The earnings per share were negative, and now it's positive as well. This company has very little debt. They just recently took on about $93.5 million of debt, and we're going to talk about that in a little bit. One thing I don't like about Duolingo is that there are slightly more outstanding shares, but that's to be expected with a smaller company. So when I look at Duolingo, I see that the fundamentals are great and that everything looks good. All the graphs are going up and to the right. So then you might wonder why the company has sold off so hard over the past few months. So if we go to the Q3 highlights of their earnings report, you can see that year over year, their daily active users is from 50 million from 37 million in Q3 of 2024, which is a 36% year over year increase. Their monthly active users is up 20% year over year, and their paid subscribers are up 34% year over year. So all metrics here indicate that the company is going to continue to grow. However, their Q4 outlook is below Wall Street expectations. It seems like investors care about future growth rather than past results, which I agree with. However, Duolingo has been growing at a ridiculous rate, and so it's expected for slightly slower growth in the future, and I'm not really too worried about this. Another big part that our investors are worried about is the increased spending. The higher spending on AI can lower profit margins in the short term. However, I believe this is short term and they'll have a great return on their investment in the coming years. So, in their shareholder letter, they actually acknowledge how growth is slowing down and how they have increased spending. So, if you see here, they even say growth was slightly slower in Q2 in part because we posted less unhinged content on our English speaking social media accounts as we listened to our community's feedback and prioritized building long term brand sentiment. We've recently started posting more unhinged content, and while impressions have yet to reach peak volume, we've seen a significant increase in them. We also modestly increased market spending to help drive momentum, particularly in the US. These actions support near term user growth, but long term gains will come from making our product even more engaging and efficient. They then go on to say, one of our 5 operating principles is take the long view. The opportunity ahead of us is to teach billions of people, and while we've made incredible progress, we know we're early in our journey. We look at 3 core areas as we look to continue to improve our product: monetization, user growth, and teaching better across all of our subjects. Each impacts our financial results on a different timeline. Monetization improvements, such as getting more users to subscribe, show up immediately. User growth improvements take longer to show up in our finances, since it takes more time for people to subscribe. One of the most important parts of my job is balancing amongst these 3 core areas, both in terms of relative investment and navigating trade-offs between them. For example, changes that boost subscriptions may have a negative impact for free user growth, so we have to determine the trade-off that makes sense. I absolutely agree with what the CEO Lewis has to say here. It's much more important to prioritize the free users because then you can convert them to paid subscribers. The reason he's saying that the growth is going to slow down in the future is because you're not going to see instant revenue. It's going to take time. That doesn't mean they're not going to continue to grow at a fast pace, just a little bit slower than they've currently been growing. And I think that's fine because over the long term, the company's going to get more money and they're going to have bigger growth over the long term. I believe it's in the company's best interest to prioritize the free users to first get people onto their platform and then convert them over to the paid subscription. By making the free version more appealing, you actually attract more users onto your platform. If you prioritize the paid version and you sacrifice the free version and take away features, then at the end of the day, you're going to have less people coming to your app over time and you'll have less revenue in the future. They then highlight where they're spending majority of their money. In particular, we're investing proportionally more in teaching better. We've prioritized user growth over monetization. We're doing this now because we want to keep growing our users for a long time and because our increasing conviction that AI can fundamentally change what's possible in how we teach. If we develop an app that is more engaging than and teaches as well as a personal tutor across multiple subjects, we think will become a much bigger business in the long term. I absolutely agree with this as well. If they can make AI teach just as well as a tutor, this will make their profit margins go up significantly more and it'll be a lot more efficient. This is why I'm going to continue to hold my position and I'm even going to buy some more Duolingo as time goes on because I believe this company over the next 5 years is going to grow significantly. Next, we move on to Meta. If we take a look at Meta stock, we can see that the revenue has been growing consistently year over year and is at a new all-time high of $51.5 billion roughly. We can see the revenue by segment. If we look at their advertising revenue, it's consistently increased over the months and years. If we look at their daily active users, it's consistently growing, and now we're at a new all-time high of 3.54 billion active users, which is absolutely crazy. It's about half of the world's population. However, despite this, the company's down 15% after earnings. Right now, out of the Mag 7 companies, Meta has the lowest forward PE, which I believe is a great deal. The company has spent significantly more on AI, and investors are not sure if there's going to be a positive return in the future. I believe this is going to be a great return. I believe over the long term, Meta is going to show that AI can really help their advertising and it's going to help increase their profit margins in the future. Right now, investors don't believe so and they're scared due to the amount of debt to cash ratio. Another problem Meta faced is they had to pay a one-time $16.1 billion tax in Q3 earnings. Analysts expected $18.6 billion in net income. However, it was only $2.7 billion which was reported, which was a big miss. This is just a one-time tax, and I think it's an overreaction of the shareholders to sell off just based on this fact alone. Their net income is going to go back up to normal next month. Nothing about the company's changed. Their fundamentals are all the same, which is why I continue to buy the dip. Now we move on to some news. We have Tesla shareholders approving a $1 trillion pay package for Elon Musk. The money will be awarded in a series of payments over 10 years if Tesla meets a series of performance benchmarks. We're going to take a look at what those benchmarks are and how this deal is going to work. Tesla announced Thursday that shareholders have voted to approve the biggest pay package in corporate history for CEO Elon Musk in a deal worth up to $1 trillion over 10 years if the company meets a list of benchmarks such as selling 1 million humanoid robots. Over 75% of shareholders voted in favor of this pay package. The package would give him shares worth up to 12% of the company if Tesla market capitalization rises to at least $8.5 trillion and is to meet 12 operational milestones. The milestones Tesla would have to meet are 20 million Tesla vehicles delivered, 10 million active subscriptions for the add-on driver assistance service known as full self-driving, and 1 million bots delivered, 1 million robotaxis in commercial operation, and 8 separate milestones for profitability. So I just want to start off by saying that I think this is absolutely great, and I hope more and more companies look at this and do the exact same thing. I believe CEO pay is getting out of hand, and regardless if companies are profitable or not, CEOs and high executives and board directors are still getting big salaries and big bonuses despite the company performing poorly. I think this is a totally fair pay package due to the fact that he only gets paid based on his performance. He only gets paid if he's able to perform and he reaches these milestones. And I think more and more companies should adopt this type of payment for CEOs. Next, we have Elon Musk celebrating and dancing with robots right after hearing that his pay package was approved.
CEO Elon Musk, with over 75% voting in favor, approved.
Right, so there you got Elon Musk dancing with robots. Not typically what you see your normal CEO of a big company doing, but that's just Elon Musk's character, and I find it very entertaining. Next, we move on to Tom Lee.
Joining us now, Tom Lee, Fundstrat Global Advisors, Head of Research, and a CNBC contributor.
Yeah, that's right. I think the market has a lot of walls of worry because we've got the shutdown, we've got China, we got the Fed speak, but the market's been up 6 months in a row now. Only 6 times since 1928 that's happened. So if you look at November, we're up 5 or 6 times. And in 1942, it was flat. So basically, November should be really strong. I think at least 200 points on the S&P. So maybe...
For November.
Yeah, maybe even 250. So maybe we get to 71.
See, that's a call that I just wish you wouldn't make a call like that, right?
Well, you could
250
to 3% if that makes you feel better.
It does make me feel a little bit better because 250 points to say in November, 250 points. You're giving a time and a size.
But maybe we wobble the first couple weeks just to digest all the gains.
Yeah, that's what I saw in your notes. So initially there could be...
Investors feel like it's a bear market, but we're up 17%, which kind of tells me I think there's a big performance chase into year end. You know, over 80% of fund managers are missing their benchmark this year.
Tom Lee highlights the Fed, China, and the government shutdown, which are all causing investors to be worried. He also mentioned how a large amount of hedge fund managers, particularly 80% of them, are underperforming the S&P 500. Since most hedge fund managers are underperforming the market, I believe majority of them are going to dump all their cash into the market. This way, they won't miss out on any more gains like they have earlier this year. This will drive the overall market up into year end. And that's all the news for today. If you wanted to see more portfolio updates, new stocks I'm buying, and the latest news, consider following. Till next time, see ya.